Hello, everyone, and thank you very much for joining us for another edition of Bank Talk, the podcast. Van, how was your New Year's?
I was going to say, Happy New Year, Ethan. It was one of rest and relaxation and a chance to get away from market chop and volatility. Much appreciated.
You know, Van, I never go away for the vacation. You know why?
Why?
Because everything always happens around this time.
Yes.
Orange County, the Mexican peso crisis, you've got this shutdown thing. It's like always just at the end of the year, there's always craziness that goes on. The market just falls apart.
Thin markets breed lots of drama. We've got lots of drama.
Well, I wonder if it's just smoke and there's not fire. You know, I kind of look at this and it's like, yeah, in the back of it, we've heard from so many of the banks. They all talk about the same fundamentals. Everything looks great. It looks great. But what's going on? Why is the market falling apart on banks?
It's funny you mentioned bank stocks, because I too have been surprised at the magnitude of the sell-off in bank stocks. Many banks are now trading back to at or around book value. Of course, what does that mean, right? Well, that means that the market is completely discounting any franchise value that a bank might have, the value of that deposit franchise, its ability to grow earning assets into a still relatively healthy economy. The other thing it might be suggesting is that maybe those balance sheet values are not true. In other words, that the markets now seem to be pricing in a fairly likely probability of recession, because that would imply that the loan values currently on the bank's balance sheets have got to come down via loan loss provision. We've discussed this a lot, recession probability. I don't feel like it's right around the corner, but clearly markets are getting unnerved a little bit about what they're seeing in markets and economically.
Yeah, well, I'm in your camp about the whole recession, but you know, there's a piece of me that says, geez, smoke, fire, where is it? What's going on? I am surprised by just the sea change in opinions. You know, and we talked about this in our last podcast too. I mean, when we did all these bank dinners, and it was a uniform view among the bank treasury people that we met that, you know, recession was, you know, further out, that the Fed was going to do 4 hikes in 2019. Everything looked set. And then literally within the space of 2 weeks, we went to maybe we'll get 2 hikes in 2019. But you know, what's the interesting question? And this is what I'm talking to banks about. Say the Fed does these 2 hikes. What's the next move after that? And the assumption for most banks is that the next move is down. But I'm asking the question, what if the next move is there is no move? What if we're just stuck here? What if we sit here with a flat to an inverted yield curve for a prolonged period of time, and then maybe you get some inflation, and then the next move is not down. The next move is up. But the assumption is the next move is down, which fits in with this idea of a recession story.
Right.
I think the reality is there is no recession story. There's just this story. And this story is a disaster for all spread lenders, right? If you do net interest margin, the thing that really is shocking here, net interest margin for the banks that KBRA rates, right, is 2/3 of the revenue pie. Yep. Some of them are up a little down, it's true. But the large banks, they're 50%. These regionals, community banks, they're 2/3 of their revenue. And you're saying flat to an inverted yield curve out to 5 years. There's nowhere for them to go.
Hang on, let me challenge your use of the language disaster, right? Because this really gets to the heart of sort of the credit versus the equity story. So yes, if you tell me that margins are now going to be under pressure, and I think that is, we're already seeing evidence of that, right? On the liability side in particular, rates are really coming up. And at a time when it's really hard to expand or get greater loan yield. So if we do imply that there's going to be a material contraction in net interest margin, so maybe your average bank that has a net interest margin of 350, maybe it goes to 320, right? That drives return on assets from, say, 110 down to 90 basis points or 95 basis points. Is that a disaster? No, not at all. Will that even rise to the level of where I am more concerned about a credit or a credit rating? I would say no. If I'm an equity guy, all of that starts to matter a lot. So I can see why banks.
I see your point entirely, Van, about if this is a temporary thing.
Right.
You're going to this acquired or be acquired.
Yes, big conference out in Phoenix in the end of the month.
How many banks we have 4,800 commercial banks in the United States. What's your prediction in the next 5 years? Where are we going to be?
I bet that number gets cut by a third.
And I bet you the margin issues are going to be a big contributing factor for it.
Well, again, and I'd argue that's smart competition, right? So if you can't compete, and when I say that the industry and many of the best players are figuring this out, but that also implies almost by definition that there's going to be a group that is not going to be able to make the smart marketing program or develop it. There's not going to be a group that can shoulder a technology upgrade budget. So all of that weaker competition is going to get squeezed out. There are still too many banks in the United States.
Okay. Well, I think we're going to leave it there, Van, and keep it going. Thanks, everybody, for joining us. This is another edition of Bank Talk, the podcast.
Thank you.